It's time to start reviewing taxes. I know, we just finished tax season, and that's exactly why there's no better time to start preparing than right now. My name's Ben. I'm a certified financial planner, and I help high earners, executives, and entrepreneurs like you protect and grow their wealth. Today, I'm sharing 7 tax planning tips to keep on your radar as we hit the halfway point in 2024. Number 1, update your withholdings. While a big refund might seem like a nice surprise, it actually could be costing you money. Some money market accounts, treasury bills, and high-yield savings accounts are still paying 4% or more. Without it, you're essentially giving the government a tax-free loan. On the other hand, owing a large amount can result in major problems too. If you under-withhold, you could be hit with large penalties that would wipe out any extra interest and more. So if you and your spouse are making significantly more money this year from bonuses, vested equity comp, brand deals, sponsorships, negotiated contracts, you may have to update your tax withholdings or consider paying estimated quarterly payments. Number 2, check your increase in interest income. Since March 2022, interest rates have been on the rise. While this has made it financially more challenging for people to take a loan out and borrow for things like houses, cars, boats, or land, it's helped the investor, like you. So if your money's been in treasury bills or money market accounts or high interest-bearing savings accounts for the last 2 years, your money has made you more money. That said, you might be generating more interest income from your investments and savings this year than you have in years past. So it's crucial to remember that you will still need to pay taxes on that additional interest income next year at your ordinary income rate. Number 3, review capital gains and tax loss harvesting. If you have sold or plan to sell appreciated securities like stocks, bonds, ETFs, or mutual funds this year in a taxable account, you'll need to pay taxes on those gains. Now, depending on your income and if you've held those securities for at least a year or more, that will be considered long-term capital gains. And the rates you'll pay are either 0%, 15%, or 20%, again, depending on your level of income. Now, this is a much more favorable rate than your ordinary income tax, which can often be potentially double that of those capital gains rates. The other good news is that if you have any taxable investments that have lost money this year or in years past, you can sell those investments to offset the other gains that you have. This is what we call tax loss harvesting. Halfway through, hopefully I haven't lost you yet. Number 4, evaluate itemizing versus taking the standard deduction. The standard deduction is significantly higher than it used to be, so most people no longer itemize. This year, it's $13,850 for single filers and $27,700 for married couples filing jointly. But if you have large state or local taxes, substantial mortgage interest, high medical bills, or you're particularly generous in your charitable donations, you might consider itemizing. Number 5, strategize your planned giving. One way to donate to your favorite charities while still optimizing your taxes is through bunching donations into one tax year. If bunched correctly, you could itemize. For example, instead of donating $7,500 to a charity every year, consider donating $15,000 every other year. A donor advised fund, which is a managed investment account used for the sole purpose of charitable giving, is a great tool to plan for something like this. Another way is through qualified charitable distributions, or QCDs, but you must be 70 and a half or older to do this. Through QCDs, you can direct IRA distributions, including required minimum distributions, or RMDs, to your preferred charity. That amount is then excluded from your taxable income in the calendar year in which you initiate that QCD. Rounding the corner towards the finish line is number 6, make traditional and Roth contributions. If you're nearing the phase-out thresholds for certain deductions like the American Opportunity Tax Credit for college expenses, or you're over 63 and looking to avoid Medicare surcharges, or you're teetering on the edge from one tax bracket to the next higher tax bracket, it can make sense to carefully manage your modified adjusted gross income through some traditional or Roth contributions. And finally, at number 7, consider a Backdoor Roth IRA contribution or a Roth conversion. Roth IRAs give you tax-free investment growth, tax-free inheritance transfers to heirs, and no RMDs. Contributing to Roth IRAs can be extremely valuable, but they're pretty nuanced and there are some rules you need to keep in mind. Remember, you have to pay taxes on this money one way or another, now or later. If your 2024 projected income is expected to be the same or lower than you think it will be in retirement, then Roth contributions and conversions could make sense for you. But keep in mind the pro rata rule for backdoor Roths. This is a nuanced rule that requires its own video, but in essence, we'd like to avoid this rule if possible. And to avoid it, consider rolling over those pre-tax IRA funds into an existing and active 401k plan, or convert those pre-tax IRA funds to Roth dollars before you make a backdoor Roth contribution. Lastly, your modified adjusted gross income will appear to rise if you make Roth IRA contributions or conversions. So be aware if you're near threshold limits for deductions or Medicare. That's it for today. There is a lot of detail and nuance in this video, so be sure to talk to a tax professional and financial planner before you make any changes to see if it makes sense for you. Remember, tax planning is a year-round sport. So instead of running away from it, I encourage you to embrace that mid-year tax review with open arms. As always, I am here to help you. So if you have any questions anytime, please reach out.